portfolio manager at Impact Folio. We are a boutique investment advisory firm headquartered in Denver, Colorado. We specialize in impact investing and holistic financial planning for one flat annual fee. Today I'm going to cover how presidential elections affect the stock market, and we're going to dig deeper into potential tax and estate planning opportunities under the Biden tax plan. So before I dig into the presentation, just a quick word from our compliance department that any tax or estate planning strategies discussed today are for educational purposes only. Please speak with your specific advisor before potentially implementing any of the strategies covered today. So we'll start first with the presidential elections and how those have historically affected the stock market. I wanted to start first with a slide that I think does a great job summing up the first presidential debate. And you can see it was pretty much a knockout. Everyone got knocked out, no survivors. Could probably even show the audience members being knocked out here. A very contentious political environment that we're in, and certainly adding to the stress of 2020. So the next two slides, I put these together to really help put things in perspective. The first slide is looking at if an investor invested $1 back in 1926, that $1 has seen many different presidential candidates, whether they're Republican, Democrat. We've seen different tax code, we've seen different policies, and I think this chart is a great illustration of just how resilient the Americans are, how resilient our economy is, and our ability to adapt. The next slide, I'm going to spend more time explaining some of the details here. So this information is actually going all the way back to 1789, our first president, George Washington, and looking at the US stock market. On the left-hand side, looking at the 3 or 4 red columns in the bar chart, this is looking at all presidents, Republican and Democrat, and it's interesting to see that historically in the first 2 years of a presidency, the stock market has lower returns. In the final 2 years of that presidential term, the stock market has historically seen higher returns. The explanation for this is more than likely it takes a year or two for the new president to kind of fire the old guard, get the new guard in place. It takes time for any of their campaign, what their strategies are to work their way through Congress and get any type of legislation passed. So you tend to see more changes in the first 2 years of a presidency, and then the year 3 and year 4 is where they've implemented a lot of those changes and they're starting to actually run their particular platform. Over in the blue section of this bar chart, the dark blue is the first 2 years, and then the light blue is the entire 4-year presidential term. I know that there's a lot of stress right now in regards to who's going to win. Is it going to be Joe Biden? Is it going to be Donald Trump? And I wanted to show this that if you're looking at this from an economic, from a standpoint, looking at the stock market, historically, whether it's a Republican president or a Democratic president, over the entire 4-year term, you can see the average annual return for a Republican president was 8.6% per year versus 8.8% per year. So over 200 years of data and really not a significant difference in average annual returns. What is interesting is with historical Democratic presidents, you have seen slightly lower returns in the first 2 years when compared to the first 2 years of a Republican president. I'm not really sure what could explain that. It could be that Generally speaking, Democrats tend to look more at the increasing taxes, whereas Republicans tend to run on decreasing taxes. So it could be a bit of an initial overreaction on the sell side, fear over increasing taxes. And I think our current environment is very similar, that if Biden wins and if we see a blue sweep in Congress, then we're likely going to see higher taxes going forward. But I think what happens is the markets realize that usually with those increased taxes are increased spending. So, in this current situation, we could see sizable stimulus next year. We could also see implementation of the Green New Deal. So that spending would ideally more than offset any pain from increased taxes. One other data point before we move on. I think it's interesting to see, if you were looking at the best historical combination purely from a financial standpoint, historically it's best to have a Democratic president and a divided Congress. That has averaged, in that scenario, you've seen an average annual return of 10.9% versus the 8.6 or 8.8. So hopefully this helps put things in perspective. One candidate's going to win, one candidate's going to lose. There's a good chance that whether you're rooting for Donald Trump or rooting for Joe Biden, that maybe your candidate's going to lose, but it's not going to be the end of the world. Especially if you're looking at it from a stock market standpoint. Historically, there has not been a significant difference. Okay, so that was the easy part of the presentation. Hopefully I haven't put you to sleep yet. We're now going to dig deeper into potential tax code changes under the Biden tax plan. I would say if you're an investor or an advisor and your CPA has been slow to respond to you over the past few years, give them a little bit of a break. We have seen a lot of tax code changes. In 2017, we had the Tax Code Jobs Act, or TCJA. That was the most significant change to tax code in over 30 years. And if Biden wins, we could very likely see another significant change to tax code next year. So I think this slide kind of sums up the state of our current tax code, that it is very complicated, continues to get more complicated, and that maybe leads to the credence of making CPAs, tax advisors, and financial planners even more important and able to add value in our clients' lives. So digging into the Biden tax plan, the next 6 slides or so, I apologize, it's a lot of text, but it was really hard to relay this information without just putting a lot of text on the slides. And I thought this could be a good resource in the future if you wanted to come back to any one of these slides. So I'm starting first with one of the easier changes to understand. And what you can see here in parentheses is increasing the tax credits are primarily targeted to lower and middle income households. And that's really a theme that you're going to see across the entire Biden tax plan, is trying to minimize or reduce taxes for lower middle income families and increasing tax rates or eliminating deductions for higher income individuals. So the first few are pretty simple to understand. As long as you're under the income thresholds, there would be an increase in the child tax credit, an increase in the dependent care, child and dependent care credit. I highlighted this third bullet point. This wouldn't be a brand new idea, having a first-time homebuyer credit. We actually had that during the Obama administration for a couple years, and it was very successful. So the Biden plan would reintroduce a $15,000 refundable and advanceable credit to help first-time homebuyers. So that's neat. And then this last bullet point would be a new caregiver credit. We continue to see America having an aging population. Many of us are now starting to help take care of our parents or our grandparents, and that means time away from your family, time away from your job. So this would introduce a $5,000 caregiver credit for those that are providing long-term care services. So that was the easy one. The next couple slides are going to dig deeper, and I'll do my best to explain these. This item would be significantly different and really flip the current planning process on its head. It would be a 180 shift from the way that we currently view pre-tax versus after-tax or Roth contributions. So I'll explain what this is. Right now, with our current tax code, if you make a pre-tax contribution to a retirement account, then that contribution will reduce your taxable income. So if I'm, for example, if I'm in a relatively lower income earner, I'm in the 10% tax rate, I make a $10,000 pre-tax contribution, then I've lowered my taxable income by $10,000, and I've ended up saving about $1,000 in taxes. So generally speaking, with our current code, lower income individuals are usually better off making Roth contributions because they're already in a low tax rate. And by making those Roth contributions, eventually when they pull that money out, it's going to be tax-free. But with this, would be introduced is a contribution credit, currently anticipated to be 26% of the contribution amount. So this is different than our current system. And I'll use an example of maybe just to keep the math easy. Let's say I'm a high income earner and there isn't currently, but I'm just going to round it off. Let's say I'm in a 40% marginal tax rate. And once again, I make that $10,000 pre-tax contribution. Well, with this credit system, my taxable income stays the same. So by making that $10,000 pre-tax contribution, I get the credit, I get a 26% credit, but my taxable income is still the same. It hasn't reduced it. So the downside of that for a higher income earner would be if I'm paying a 40% tax rate, but I only get a 26% credit on that contribution, then in essence, I'm still paying the difference in taxes. So I'm still paying a 14% tax rate, even though I've put that money into a pre-tax retirement vehicle. So now when I eventually retire, and let's say I'm still a high income earner in retirement and I'm still at that 40% tax rate, I've essentially paid taxes on that money twice. I paid roughly 14% taxes as it went in, and now I'm paying 40% taxes when it comes out. So if this were to pass, it really flips the equation. Your high income earners may actually want to contribute on a Roth basis, and your low income earners may want to contribute on a pre-tax basis. So that way you're still going to get the 26% credit, which is more than what if you're in a low income tax rate. If you're at 10%, then that's still more than the taxes that you would pay on making that contribution. So a couple planning opportunities here. This would be primarily for your high income earners. So I just mentioned ideally making Roth contributions. Other ways that you could get funds into Roth accounts would either be making after-tax contributions to your company sponsored plan, and if they have the ability to then immediately convert those after-tax contributions into Roth funds. That is one indirect way to get money into a Roth 401k. And then the other strategy is similar in nature, where you make a non-deductible contribution to a traditional IRA, and then you immediately convert those funds into a Roth IRA. There are a lot of rules that you need to follow for either one of those two strategies. So that is not something that you generally would want to do by yourself as an individual investor. Highly recommend having a tax professional or planner help you if you're going to utilize one of those strategies. The fourth bullet point, this is interesting. Business owners, once again, if this changes, your employee pre-tax deferrals really wouldn't help to reduce your taxable income. So if you can, and if you're the business owner, especially if this is a smaller business, ideally you want to try to increase the employer contributions into your company sponsored plan. And the reason why you would want to do that is the employer contributions would help to reduce the overall net income of the business, helps to reduce the taxable income that flows through to the business owner. So looking at plans that do allow employer contributions would be profit sharing plans, SEP IRAs, defined benefit plans, cash balance plans. And then lastly, another potential strategy, if I'm a high income earner, I've got a lot of pre-tax assets already, I may want to consider converting some of my pre-tax accounts to Roth accounts in 2020 and pay the current tax rates, which are likely going to be lower than tax rates that you'll see in the future. Okay, I know that's pretty heavy, but we'll continue on. There's about 4 or 5 more slides. I put both of these together. The first bullet point would be the elimination of the step up in basis rules that currently apply to inherited assets. I think that change is highly unlikely. The second bullet point here, a 50% reduction in the exclusion amount for estate and gift taxes. So essentially right now, today, each individual could pass away with up to $11.6 million or a net worth of $11.6 million and not pay any estate taxes. Under the Biden plan, that would essentially be cut in half to $5.79 million per person. I put these two together because I've heard and read that the first bullet point was added probably more as a negotiation point, so they can, in any typical negotiation, you start high, knowing you're not going to get everything that you want, and you end up meeting or compromising somewhere in the middle. The elimination of the step up in basis, that would affect a lot of Americans. It wouldn't affect just your high income earners. So it would be very unpopular. There have been 2 large efforts in the past to pass this type of legislation, and they were both unsuccessful. So unlikely, but that should be on our radar just in case that does pass. That will significantly change estate planning. Under our current rules, for example, let's say my mom is planning on leaving me her home. And if she's lived in that home 40 to 50 years, let's say she's got a really low cost basis of $50,000, but the home is worth $2 million. Under our current rules, at her passing, the cost basis in the property would step up to the current market value, and then I would inherit that asset, be able to turn around and sell it, and there would be no gains, no taxes that come into play. If the step up in basis is eliminated, then in that same scenario, either her estate or would have to realize those gains and pay the taxes in the year of her passing, or the cost basis would also pass to me, the beneficiary. So then when I eventually sell the home, I would be paying sizable capital gains. So the reduction of the exclusion amount is much more likely to pass. We've seen the exclusion amount flip-flop or change throughout history. It tends to increase when the Republicans are in power, and it tends to decrease when the Democrats are in power. So even though 5.8 million per person is still a lot, and the majority of Americans would not be affected by this, there are a lot of individuals that would be affected, especially if you happen to live in a state where real estate has really just taken off in the past 2 decades. You know, if you live in California, New York, Colorado, real estate is accelerating as well. So as far as what you could do or potential planning strategies, looking at the second to last bullet point here, you could, if you feel that you would be affected by the reduced exemption amount, but you would benefit by utilizing some of the higher exemption amount this year, you should talk to your accountant and your estate planner, your financial planner, and see if it makes sense to start gifting some of the assets now so you can start to use up a larger portion of that exemption. And ways that you could do that, looking at the last bullet point, there's pretty advanced or complex wealth transfer vehicles such as grantor retained annuity trust, charitable lead annuity trusts, and intentionally defective grantor trusts, which are all complex and highly recommend working with a competent estate attorney if you're exploring any one of those vehicles. Okay, this slide is a little bit easier to digest, and this is really targeted towards your higher income earners. What this would be, and I'll highlight here on the chart, this would be an increase in the marginal tax rates at the higher end of the spectrum. Our current, if I'm looking currently at our rates for a married couple filing a joint tax return, once you go over 400,000, then you do move into the 35% or potentially the 37% marginal tax bracket. The Biden tax plan would eliminate those two brackets and replace it with a 39.6% rate, which, you know, if you're already in that 37% rate, then going from 37 to 39.6 may not be a big jump. But if you're currently, you know, right on the border of that 32 to 35% rate, then going from a 32% rate to almost a 40% marginal tax rate would be a significant jump. You'll see in this slide and in future slides that 400,000 is really the number that the Biden administration has currently decided is kind of that cutoff between what's considered wealthy and lower income. So 400,000 is where we would see higher marginal tax rates. On the next slide, once again, 400,000 is really the magical number that through tax planning that you would like to stay under or keep your clients under. On this slide, one of the proposed changes would be if a business owner has over 400,000 of taxable income, then they would lose what's called the Qualified Business Income Deduction, or QBI deduction. This is a relatively new deduction that a lot of small business owners currently enjoy. It was introduced in the TCJA in 2017, and high level, it provides approximately a 20% tax deduction as long as you qualify. So the hard part to plan, one of the challenges of this rule or code, if it gets enacted, would be keeping track of what your clients or what that business owner's current income is for the year. A lot of business owners, their income will fluctuate throughout the year, so you may not know if they're getting closer and closer to that 400,000 threshold. And then the other challenge would be other sources of income could put them over that $400,000 number, and then they end up losing the entire QBI deduction. So that could be income from a spouse. So your husband or wife or partner gets an extra bonus one year, and that extra bonus now puts you over the threshold, and now the business owner just completely lost that deduction. One strategy that you may end up seeing, or as advisors may make sense, would be shifting income producing assets, moving them out of taxable accounts and moving those income producing assets into retirement accounts. And so that would be looking at investments that maybe generate a lot of income, such as bonds, or if you've got a strategy with a lot of turnover that creates a lot of capital gains, or short-term capital gains, long-term capital gains, it all counts towards that $400,000 number. You may want to shift more of those type of investments into the retirement accounts. Moving on, this change or this slide would not affect the majority of Americans, and it really would affect a kind of a narrower subset, those that are high income earners and usually those that are charitably inclined. So what this would do is put a cap on the value or percentage of itemized deductions. Most Americans don't itemize now. One of the nice changes of the Tax Cut Jobs Act of 2017 is the standard deduction was increased for everyone, and that's usually more than itemizing. But you may have a case where a high income earner, once again, let's say they're in that 40% tax rate, they're charitably inclined, and they make a significant contribution to various charities. Under the current tax code, they would receive a sizable charitable deduction that could be itemized, and that may be is likely more than their standard deduction. Under this scenario, if I'm in that 40% tax rate, and let's say I made a $100,000 charitable contribution, I only get to deduct 28% of that. So the difference is about 12% that I would end up still paying taxes on, even though I donated 100% of that money. So I hope that doesn't become a detriment to higher income earners that are charitably inclined, and it doesn't lead to less charitable contributions. I guess we'll have to see if this gets passed and how it does affect charitable contributions. One strategy that could come into play if an investor or one of your clients is charitably inclined, they plan on continuing to make sizable donations to charities in the future, they may want to consider making a kind of pulling forward a lot of those future charitable contributions into 2020. And they could do that through what's called a donor advised fund, or a DAF. The nice thing about a donor advised fund is I could make that same $100,000 contribution this year. That way I benefit under the current tax code in 2020, but then going forward, I could use that donor advised fund to make contributions to charities in the future. So you're still supporting charities in the future, but you're maximizing your tax deduction in 2020. All right, another item that is certainly geared towards the higher income earners, and this would affect those with over 1 million in income. Right now, if you're looking at our current tax code, there is the tax rate on ordinary income, and then there is a much lower tax rate on capital gains and qualified dividends. So what this change would do is it would still keep the capital gains rate the same for those that make 1 million or less. So there wouldn't be a change on that front, but any gains over the $1 million threshold would actually be taxed at ordinary income rates versus the more attractive capital gains rates. So let's say I'm an investor. I have $1 million salary, but I end up selling investments that are generate 500,000 in gains. Well, in that scenario, instead of paying an attractive 23.8% rate, capital gains rate on those gains, I'm now going to be paying 43.4% on those gains because that is over the $1 million threshold. So planning opportunities, try to minimize taxable income, do what you can to keep your client under that 1 million mark. You would like potential ways that you could potentially do that, especially if they happen to have investment properties and they're considering selling those properties. You could review the merits of 1031 exchanges. That is essentially selling one property, using the proceeds to buy a new property, and you're deferring paying the gains because you're moving the cost basis from property 1 into property 2. At some point down the road when you sell property 2, that's when you would realize those gains. I put in parentheses if allowed at this income level, because the next slide I'm going to cover 1031 exchanges may be eliminated for high income earners as well. So other strategies to minimize your gains would be to try to spread out your gains. So whether that's doing that through installment sales or just making sure you're focused on not realizing too much in gains in a given year, or if you happen to have a year where your client has recognized significant gains, look at ways of potentially offsetting those gains, potentially through charitable contributions. A couple other methods would be, instead of using traditional bonds inside of taxable accounts, you could utilize municipal bonds in those non-retirement accounts. And the logic there is the interest that they generate is free from federal income taxes, and depending on what type of municipal bonds, they may be free of state income taxes as well. And I mentioned this before, you may also want to consider moving or shifting your income producing investments out of non-retirement accounts into retirement accounts. Just another way that you're trying to minimize your client's overall income for the year. And then lastly, if you have clients now that have significant unrealized capital gains in their positions that could create issues in the future or could cause them to pay significantly higher tax rates, you may want to consider accelerating and selling and realizing some or a good portion of those gains in 2020. All right, this is the last slide on the Biden tax plan, so hopefully I haven't lost everyone yet. So I mentioned on the previous slide that 1031 exchanges would be eliminated for taxpayers with annual incomes over $400,000. So we've come back to that kind of that magical $400,000 number. What's a little confusing right now is it's not clear if the embedded gains in the underlying property would count towards that $400,000 number. If it does, it would be really difficult, if not impossible, to plan around this, because usually when someone is looking at utilizing a 1031 exchange, they tend to have significant unrealized gains. It's easy for a client to own a piece of real estate for 10, 20, 30 years and have hundreds of thousands of dollars in gains. So we obviously need more clarity there to see if the embedded gains count towards that $400,000 number. Hopefully they don't. But this could be, if the 1031 exchange is eliminated for taxpayers over $400,000, it has almost an exponential effect for those individuals, because not only have they now lost the ability to defer paying taxes on that property, which saves them money now so they can use that money for other investments, but it may also put them over that $1 million threshold that we talked about on the previous slide, And if that's the case, then they could potentially go from paying from potentially deferring the taxes, now paying almost a 43% tax rate if they're over that $1 million mark, versus the more attractive 23.8% capital gains rate. So the planning opportunities here are challenging. We'll definitely need more clarity. And like I said, if the embedded gains are included in this $400,000 number, it might be impossible to really plan around this, and it might cause investors to hold properties much longer than what they would like, and hold them instead of potentially selling them and utilizing a 1031 exchange. I think that this change is unlikely as well, similar to the elimination of the step up in cost basis. My main thought process here is there's a lot of tax code that encourages investing in real estate in America, whether that's through your own primary residence, or a lot of the tax breaks of making real estate investments. So it's really ingrained in the American culture, and very popular as well. But we'll see. So thank you for sticking with me through the summary of the Biden tax changes. I've got 2 slides that I want to wrap up today's presentation, and both of these slides are really meant to put things back in perspective again. So I know that 2020 has been a very challenging year on many fronts. There's the pandemic, the presidential election, the social unrest, the rioting. So 2020 has certainly been a dumpster fire, but similar to any environment or any situation, there's always a silver lining. And here on the next slide, we've got the Snoopy and the whole Peanuts crew making a silver lining out of 2020 being a dumpster fire, enjoying the heat from the fire and singing some songs. But all joking aside, the last slide is meant to put things in perspective in regards to any stress that you or your clients may be feeling in regards to what's coming up in the short term, whether it's when will the pandemic end and who's going to be our next president. So this slide is neat in that what it shows is data going back for the past 70 years, looking at an all stock portfolio, an all bond portfolio, or if you simply had a 50-50 mix. And really what this is trying to show us is if you have a short-term perspective, which is looking at all of the rolling 1-year periods, there is going to be a lot of uncertainty, a lot of risk in the short term. So, if you were invested in all stocks looking at 1-year periods, you could make anywhere from upwards of 47% and lose as much as almost 39%. But if you simply take your time frame and extend and look at a longer time frame, and especially if you follow the time-tested rule of diversification and making sure you've got a good mix of stocks and bonds, you can see, looking at the 5-year rolling periods, a simple 50-50 portfolio between stocks and bonds never lost money in any one of those 5-year rolling periods. Your worst 5-year return was a positive 1%. And it continues to get better the further out, the longer the time frame that you look at. And I think this is a testament to why stocks are really good long-term investments. If you're looking at 20-year periods, even a 100% stock portfolio has never lost money. So that is the end of the presentation. I hope you found it helpful. I'd be glad to answer any questions. Feel free to give me a call or send me an email.